All right. Welcome everyone to episode 15 of the Ninja Wealth Exchange podcast here. How you doing tonight, Johnny?
Good, good. How you doing, man?
Good, man. Looks like you got a fresh haircut too, huh?
Yeah, I had to do it.
Nice, nice. Looks good. Looks good. Um, yeah, so today's show, we're gonna talk about securing the bag, right? A deep dive into how to fund your next investment property, right? Um, Something that's very important, right? That we work with a lot of investors, right? When they reach out to us, one of the smart questions that we ask right away, after they ask about a deal potentially that they're looking at, um, the conversation always leads to, "Hey, how do you plan to buy this thing?" Right? Pretty
Mhm.
important question to ask, and as an investor, pretty important question for you to know, right? To know ahead of time, potentially, right?
Yep.
So, today's episode, we're going to be going into talking about conventional loans versus DSCR loans, right? And then a little bit of start with a little bit of mindset here, because not every single investor that we talk to is open to loans or using finance, right? Whatever that might be, they're anti-debt or that type of thing. Um, and then also, what do you secure first? Do you get your loan strategy or do you go find the deal first? Right. Um,
Mhm.
so hopefully by the end of this episode, we can give you a little bit more clarity and confidence, and you can define your strategy better, right? When you're looking for that deal. So let's start with into it. And this episode, I'm just gonna be kind of interviewing Johnny because he's the mortgage expert. He's got like 20, 30 some years, started when he was 5 years old or something like that, So
That's what it feels like.
he's the expert. So I'm just gonna shoot a bunch of questions at him, right? So let's start off with first the big picture, right? And so the mindset portion, right? So why do investors, or why should investors use leverage funding using other people's money, OPM, right? Instead of their own money, their own cash.
Yeah, so I mean, there's a few different things, right? There's we're looking at opportunity costs, right? And if you don't have the funds and you don't have the ability to jump right in, it makes it a little bit difficult for you to be able to jump in, right? So because you will need funds, someone's got to have to fund the transaction. And so if you're not leveraging, you're not going to be able to have funds to be able to start your transaction. Now, when we say opportunity cost, we also talk about the loss of a deal because you didn't have the funds, or uh, you didn't even jump in, so you couldn't even gain the appreciation or use the depreciation um, or begin to grow at all, right? So like you got to start somewhere, and oftentimes people will jump in and they'll get some kind of financing or some kind of a partner to jump in to pay for the transaction. In addition to that, there's a possibility that we'll lose time, right? Because if you're waiting to save up for the cash, it may take you forever. If you're like most people I know, and most people meaning like I've worked with thousands of clients over the last 20 some years in the mortgage industry, and it is extremely hard for people to save up, right? Of course, they have their 401k, and yeah, you can use that, but most people would like to use what's in their bank account. And oftentimes, things come up, right? And because things come up, you're going to use that money. You might save $30,000, and then all of a sudden something comes up. You got to buy a new car, and then you're using that money, right? And so, if you're waiting to save up for the down payment, that takes some time, and so you're going to lose time in that process. In addition to that, what's really cool about getting a loan is that you're using someone else's money, right? And then you're just paying them back, and over time, right, there's inflation, and inflation will erode, right, it'll erode the loan cost, if that makes sense. But I also want to say, it erodes the buying power as well. So when you're looking at not jumping in, there's a likelihood that the values of homes will increase. So if the values of home increases, um, and you didn't jump in, then you need a bigger loan to be able to do the transaction. Now, secondly, if you did the transaction, right, and inflation happens, right, the money's not worth what it used to be, right? So you're gaining on that on that end. And then finally, um, it allows you to be able to jump into multiple deals, right? So say for example, you have a little bit of money, you can split that money and pick up more than one property, right? And to be honest, today we're going to be looking at 1 to 4 units mostly, right? If you want to do something like somewhere between 5 to 10, we could probably do a DSCR on it. But usually when you're going from 5 and up, we're looking at using some kind of commercial loan. So today we're talking about conventional DSCRs and those kind of things. To be honest, I think if you're not getting a loan, like you're losing out. You're losing out on opportunity. You're losing out on time. You're losing out on so many different things. In addition to that, when you're leveraging, right? Say for example, you bought a house, right? And you decided to rent that one out and you're making good money on it. You had enough cash to go buy another house for you to live in, right? In order for you to level up and scale, the likelihood is you're going to need other people's money, right? And if meaning scale and scale fast, right? If you want to scale slow, fine, right? Take your time, pay off the houses that you have, and then go for it. But I mean, if you're looking at 30-year mortgages, you're going to be paying that mortgage for a really, really long time before you can actually scale up. So we recommend obtaining financing to scale up. Of course, you want to make sure you're cash flowing, right? In addition to that, time, right, as well as interest rates sometimes kills deals. So if the rates increase, right, because of time and you didn't jump in when you could have, then now you're not able to jump in, right? So back in 2020, 2021, interest rates were like right around that 3% rate for mortgages. And when you were looking at that 3% rate, people are jumping in, people are doing amazing things with it. And because you didn't jump in, 2 years down the road, rates are at like 7.5% for investment properties. And now you just can't even come in because interest rates are too high, monthly payments are too high, the property is no longer cash flowing. So there's a bunch of different things that we really, really need to cover when it comes to financing, as well as help you understand whether financing is right for you or not. And for most people, if you're getting into investing, you're going to need some kind of financing, whether it be a partner that's going to be financing the deal, whether it be a bank, broker like one of us, or some kind of loan, right? So
Mhm.
that's my take on that.
Yeah.
Is there anything you want to add?
No, I mean that's pretty good. So I mean one of the other common pushbacks that I get from potential clients is that they look at the interest, right? The amount of interest that they have to pay at the end of a loan, right? When
Mhm.
we hand them the rate term sheet, right? And they're like, "Whoa, at the end of the 30 years, I have to pay like, 50% of what I'm paying. Why not of the purchase price, right? So, yeah.
Yep.
Why don't I just pay it all cash right away? So, why? Why, Johnny?
Well, I mean, so there you could, if you had the cash, you could pay cash right away, but then now you can't scale,
Mhm.
right?
Right.
Scaling becomes tough. You could use all cash if you wanted to jump in and do that, but
Mhm.
now there's a few different things that could take place, right? Say for example, if a lawsuit comes your way, right? You're not leveraging, and so it becomes your liability, right? That's one aspect of it. Another aspect is when you're jumping in and you're having a lender actually vet out the numbers, right? They're doing an underwrite on your property, right? So you have a second layer of people, a second layer of eyes looking at it, determining whether it qualifies or not.
Mhm.
And
Mhm.
so if you're doing it by yourself and you're paying cash, that's totally fine, but now you don't have that second layer, right?
Good point.
And you're buying cash, um, technically, yeah, us realtors, we can give you a really good roundabout number of where the value of the property is, but you're not getting an appraisal, right?
Mhm.
And so if you're gonna like, luckily for my clients, right, I actually know how to appraise homes, and so you get you jump in there, you run the numbers, and you could probably get somewhere really, really close to what the appraisal is going to be, because
Yeah.
every appraisal is going to come in a little bit different. But the thing is that most realtors, most loan officers don't know how to run the numbers like a appraiser does, and so you might be buying it if you're buying it cash. You don't actually know how to calculate value. You might be buying it overpriced. I mean, there's so many different aspects to having a loan that it gives you an advantage to work with with the people that are getting you in a position where you can actually qualify for the specific property, and to see if the cash flow actually work, to see if you're leveraging correctly, and so on. So
Yeah.
um
No,
that's my 2 cents on that.
yeah, no, that's a great point that when you do utilize a loan, you do have, not only is the lender providing you the funds, but they're also kind
Yeah,
of like checking your homework, right? They're kind of like the
yeah,
teacher, right?
yeah.
Because if the number don't work for them, they're like, no, your deal doesn't work, right?
Yep.
So they're your second set of eyes. And yeah, what your agent can help you, right?
Mhm,
Um,
mhm,
but of course, at the end of the day, it's your deal, it's your numbers, it's your debt. So you better know how
mhm.
to underwrite for yourself too, right?
Yep,
Um,
yep,
and yeah, the appraiser does underwrite the deal as well. So that's a third party person, not the bank, right? Or not the
mhm,
lender.
mhm. Yep.
So that's a great point. And then I guess the other point is that I was trying to allude to is that, if you have a rental property, right? Um, and it actually the numbers make sense, you're not actually the one who's paying that mortgage, paying that interest,
Yeah,
right?
absolutely.
Your
Yeah, and
tenant
you're
is
writing
paying that
off.
mortgage for you,
Yeah,
right?
you're writing off a ton of that stuff, right?
Yeah, yeah.
So yeah, so they pay, your tenants pay, right?
Mhm.
And then after your tenants pay it, and you as the landlord, or you as the property manager, or the owner receives the payment, right? It pays for the interest. Now, after it pays for the interest, you can actually deduct that in your taxes, right? So you're going to get some of it back. And so
Yep.
you're not technically, not only are you not paying it, but you're receiving income from it. That's how I look at
Correct.
it.
Right, right, right. So yeah, your tenant's helping you pay your mortgage, right? So
Mhm, mhm.
if you're buying the right deal, it definitely is gonna make sense, right?
Yep.
And so just finishing up with some questions here, right? That you should ask yourself, when you're looking at these deals, right? Does it cash flow, right? Especially if you are, trying to cover a mortgage, get funding, right? Chances are the lender's not going to give you money on a deal that doesn't cash flow unless you have some kind of plan for it, right?
Mhm,
Um,
mhm.
and then, you know, can you refinance it later if the rates are high today? Well, and you're concerned about rates, right? You could, right? You could reposition it later when the rates drop. Um, and then, of course, um, appreciation factor. While we don't, as investors, you shouldn't uh, rely on appreciation, right? As something that's going to bail you out in the future. Because we never really know how much a property is going to appreciate or if it will, right? But it is something that it's kind of like if everything goes well and your property does actually appreciate a lot over the years, right? Um, it could be very well for you, right?
Mhm, mhm.
So,
Yeah,
all
no,
right.
appreciation is a great thing. We had that conversation with
Yeah.
TL,
Uh-huh.
and
Right.
that was massive. So
Yeah, 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 yeah. And that's not something we can predict accurately, right? Like who would have guessed that his market would have went from like 200 some thousand, 300 some thousand to $1 million, right?
yeah, yeah, I have no idea.
Yeah. So, but yeah, once you understand and you have the funding mindset, right, that hey, this is what you want to do, this is how you're going to acquire property, right? The next question kind of becomes, oh, well, should I secure my funding first, meaning get a pre-approval or that type of thing, or should I go find the deal first and then try to get pre-approved? Um, what's your take on that?
Yeah, so my take are you should get a lender to work with you, right? So that they can help you understand. Of course, like a- any good realtor would tell you to get a pre-approval first, right?
Yeah,
And
so you don't
so I
waste your
do
time.
recommend I do recommend getting a pre-approval, talking to the lender, giving them an idea of what it is that you were planning to do, and then having them run numbers, right? Now, as an investor, you're going to have to run your own numbers too, right? So, just
Mhm,
because the lender approves it doesn't necessarily mean that you're going to cash flow. Now, if you have a ton of cash and you're loaded and you can always just pay it off, there's a likelihood that the down payment you put in will probably allow you to cash flow, but that's not what we're trying to do here, right? We're trying to leverage as much as possible so that our money that we have is making money on in other fields, while we're using just a small portion and other people's money, right, like banks and lending institutions, to be able to increase your positioning, right? um so yeah, get a pre-approval first, right? But there are situations where, depending on the type of property that you're trying to get and depending on the location, the numbers will change, right? So let's say, for example, if you were trying to buy a house in okay, so I'm going to use my locations, right? Because I'm here in the Twin Cities and I know these numbers better than most of the United States, right? Or anywhere outside of my normal location. So let's say you're going to be using long-term rentals and you're going to be purchasing a property in St. Paul. The monthly payments will probably be somewhere around, like let's say $3,000 a month, right? And let's say you're picking up a duplex. Well, you're going to have to make sure that each of the duplex is going to produce 1,500 a month, right? $1,500 a month in order for you to even just break even, right? But if you decided to not buy in St. Paul, right, and you have the same monthly payment because the price is similar, but you buy in, let's say, for example, a city like Oakdale, right, which is a suburb of St. Paul, you're going to get more rent there, right? And you might qualify for more in because the rent there is going to be higher. So depending on the specific location, it might change. However, you still want to get a pre-approval, right? Because you want to see what you can qualify up to if there are specific scenarios, right? So, like for investment properties, you'll probably be going back to your lenders more often than if you were not an investor and you were just uh, just a buyer, right? If you're just a buyer, you see the house that you like, you can go ahead and just go back to the lender, get updated pre-approval with the correct purchase price, and then you're good to go, or with the address, and you're good to go. But when it comes to working with your lender, you want to find an investor lender, someone that understands the numbers, right? Someone that can actually calculate, because when you're doing investment properties, you're going to be using rental income from the subject property to qualify. And so, depending on the location, depending on what it is that you want, it may change. And so, my thoughts are is that talk to them, get specific with the town that you want to do business in, with the type of property that you want to do, and then that'll give you more clarity as to what you qualify for and don't qualify for.
mhm, mhm, yep, and, yep, so I agree. Gives you clarity on how much you can afford and the loan strategy that's gonna hopefully work for the type of property you want, right?
Hmm, hmm.
Because if you're targeting, like, duplex for single family or multifamily versus single family, right? There
Hmm.
are differences. There's
Yeah,
not all loan programs will work, right? Um,
correct.
or there's different terms or things like that, right? Different rates too, right? Rates are different between a single family and a 2 to 4 unit
Yeah,
or
they
5 to 10, right? So you
are.
have to know all these nuances. Um, and then, you should start working with or start talking to a couple lenders, right? So
Hmm.
you have that relationship built already ahead of time because you don't want to just start building that relationship when you like, hey, I found this property. I'm under contract already. I don't have, and then you're trying to get pre-approved. And your deal is supposed to close in like 30 days and you already wasted like 7, 10 days, right? it's
I
gonna be
mean,
difficult.
that's happened to me before where like you get a
Right.
client that
It's gonna be
jumps in
difficult.
and they're like, yeah, I've been under contract for 10 days. My financing contingency is coming up. I need you to run numbers. And I'm like, wait,
Yeah.
hold up. Like,
Yeah.
these
I need
numbers
you
don't work.
I need you to save my deal here. Save my
Right.
earnest money. Yeah, right?
And it's like, yeah, these numbers do not work. So I
Yeah.
can't work with you on this one.
Right, right, right. And sometimes, it's good to have backup options because heck, if the loan gets denied for whatever reason, at least you have another backup lender that you've been talking to that can jump in, right?
Yep.
So
Yep.
it's kind of the important thing here. So, all right, so let's get a little bit more into details here on the type of loans, and like we mentioned today, we're just going to really focus on conventional loans and DSCR loans. Um, so first, let's start off with the conventional loan, right? So conventional investor loans.
Mhm.
What is that?
So a conventional investor loan, right, is a loan where you're not buying it to live in, but you're buying it so that you can actually invest in it. Meaning you're going to be renting it out, whether it is long term, short term, midterm, or basically you're looking to make money on the property, right? And so when you purchase it, conventional loans they have different guidelines than when you're purchasing a primary. So oftentimes, if you're buying a single family, you might be able to put like 15% down and be just fine.
Mhm.
Um, Usually, we don't recommend second home loans for investors, right? We recommend you go ahead and just do a 15% down conventional product. Um, they do allow decent terms, right? So, like if you went commercial, uh, you would be in a balloon loan. However, when you're using a conventional loan, it is fixed for oftentimes it's fixed for 30 years, and you have other, of course, other options like 15 years, 10 years. You also have arms and so on, but they're not usually a balloon loan. They're usually a fully amortized over 30 years. So that's really, really good. And then
What
of
does balloon
course
mean?
but balloon means that, once the term comes up, so there's going to be a term period, right? And let's say, for example, it's a 5-year term. After
Mhm,
5 years, you either have to refinance it or you have to pay it in full, right? When the balloon ends. And
mhm.
so therefore, if you have a balloon loan, right, you're going to have to pay it up. If things change, let's say, for example, interest rates go up, your monthly payment's going to increase when you refinance it. You got to really make sure that you still qualify. And then when it's a commercial loan, you're being qualifying based on the income of the property. And so therefore, if it doesn't produce enough income, you won't get one. You won't get you won't be able to refinance. So conventional loans are really nice because their term is 30 years, right? So even
Fixed.
if you got an arm, right? An arm is a adjustable rate mortgage. Even if you got an arm, the rate might adjust, but the term is still over 30 years.
Mhm.
And I don't know. We'll see if we go over to the 40 and the 50-year loans and whether they allow that for investments or not. I think that's still to come, right?
Mhm, mhm,
But for right now, you can definitely do a 30-year. Um, and then for conventional loans, you actually so depending on the individual, right? And depending on the lender. Some lender takes, somewhere between 30 to 45 days. I know that we on average we do it under less than 20 days, right? So we're actually pretty quick with the closing time on conventional loans. But the thing with conventional loans is you can only own so many properties under the conventional program product, right?
mhm,
So what that means is that if you are listed as an owner on a conventional loan, you can only have 10 of those. That doesn't matter if you're joint with someone else or not. If you're on a conventional loan, that counts as one unit, right? And so the max that you can have is 10 units per conventional product. Now, there are some folks that I know that they'll do four conventional loans over four different investment properties, and then they'll do a commercial loan and blanket it, and then come back to do to do conventional loans. And that makes it sound like, you can probably do it infinitely, but banks begin to look at you as an investors, and most institutions don't really like investor heavy uh individuals, right? So investment heavy individuals. So like, let's say for example, I know, like, I used to be at US Bank, right? So I know that they had some guidelines where your max investment properties with them, right, whether it's conventional or not, is three. Right. So when you go there, after you get three, you're done. You got to go to Wells Fargo. You got to go to a different institution to give you another conventional loan. Of course, at the end of the day, you can do 10 of them, but that's your max, right?
Hmm, interesting.
And then, of course, most conventional loans you cannot do in an LLC, right? Once in a while, you might be able to get away with one or two, depending on the institution. But for the most part, when you go and you ask people about it, they're going to say no, right? You're not going to be able to
Mhm.
close in your LLC. The only time I've ever seen a home purchase in an LLC is when it was actually their primary home.
Really?
And yeah, so they purchase a primary home in their LLC, but it's because they have what is it? Usually it's a giant or it's a decent sized loan, and it's because
Oh,
they're
jumbo?
purchasing, what was that?
Like a jumbo?
Like, you can get to the jumbo size, but like, the conforming loan limit is over 800, right? So
Right, right.
let's say, for example, you live in a small town, right? And you don't
Mhm,
want anybody to know, like, you own a business, you don't want anybody to know who you are, right?
mhm.
And you have an LLC. Well, um, you want to buy the property in LLC so that nobody knows that you actually own that property, right? So
Sure.
then sometimes they'll allow that, right?
Mm.
But it's very rare, right? You don't see it
Yeah.
very often.
Yeah, I don't. I mean, I thought, Fannie, Freddie, conventional loans are for people, not LLCs. I thought that's pretty much in their guideline. Though
And
that's
and that is correct, unless you're a specific type of person that wants to keep it secretive, and then they sometimes allow that. Now, like I said, it's very rare, but it is possible.
okay, interesting. Okay, so conventional loan rates, right, are did you get the specifics about rates?
I did not. Interest rates are pretty standard, but they're going to be higher than your primary home and second home.
Mhm,
Usually higher than your second home, but they're
mhm.
definitely going to be higher. The interest rate's definitely going to be higher than your primary home conventional loans. But conventionals is probably one of the more favorable rates across all the different other products for investment properties.
Right, right. So, for example, let's say, I know Friday, everybody's talking about conventional rates are about 5.99, right?
Mhm.
So, if so that's normal purchase, single family home if you're going to buy it, right? As a normal home buyer, right? That's
Correct.
probably the best rate you can get right now. Um, Now if you were doing an investment loan on a single family, it'd probably be what, like 50 bips, 0.5% higher, something like that.
Usually 1.5
Usually one.
almost.
Okay, one over. Okay. Yeah, something like that,
Yeah.
right? So anywhere, and then it duplex and fourplex, those even have a little bit more, right?
Mhm, mhm.
Right.
Like,
So
maybe another quarter
another,
point difference.
yeah, right.
Yeah.
Then yeah. So that's something to be aware of. Down payment wise, do we go in specifics on that?
Yeah, I talked a little bit about it that,
All right,
for conventional, it's 15%,
okay.
for
And then
single
two to four,
families, then, yeah, 2 to 4 would be, probably closer to 25%.
right. Yep. Yep. Okay. And then now what if somebody wants to buy a vacation home and they want to Airbnb it when they're not there?
Yeah, so if you're doing a vacation home loan, which is totally possible, minimum down payment is 10%. Um, However, you're required to be in that property for a minimum of 15 days out of the year. based on like some of the federal tax guidelines out there, right? So of course talk to your CPA, right? We're not CPAs here. um, the thing is that when you're buying a property, if your intention is to use it as a second home, then we'll do it as a second home loan. But if your intention is to really rent it and make money, then we would suggest that you use an investment loan.
Mm. Do you know if you can do a second home loan on a duplex or fourplex, or is it primary only?
No, it's primary only
Or single
on
family only? One unit only, sorry.
yeah, one unit only. Yeah,
Yeah, okay.
yeah, yeah. That's
Just
correct.
curious. All right. Okay, so let's get into DSCR loans, the other type of loan that over the last couple of years has been really frequently used by a lot of investors. So what does DSCR stand for? What does it mean?
Debt service coverage ratio. So what that means is that your income, right, from the specific property has to be able to cover the debt, right? So the ratio, right, is I believe it is income divided by debt, and as long as it's over 1%, you're going to be fine. Um,
Mhm.
if you're not over 1%, then you're going to be running into issues. Now, every DSCR lender, so like we work with a bunch of wholesale DSCR lenders, and every one of them is a little bit different. There's not many anymore that does the 1%, right? A lot of them are starting to do the 1.1, 1.2, sometimes even 1.25. And so, you're going to have to talk to multiple different lenders if you want the 1%, unless you're going to talk to a broker like me, where or like Lore himself, where we have a bunch of different lenders and we can use multiple different lenders. But
Mhm.
DSCRs, they're limited to certain, like a lot of the wholesale DSCR lenders are limited to specific states that they work out of. And so depending on the state that you're in, it might be a little bit more complicated than another state, right? So those are things that are necessary. Um, when it comes to qualifying, right? When it comes to qualifying, there's a bunch of different things that you're going to need, right? Now, number one is you're going to have a decent credit score, right? So most DSCR lenders require 680 FICO scores or credit scores or higher, right? So if you don't have a 680, there might be some possible DSCR lenders out there, but most of them are going to say no to you, right? You have to have your credit down pretty well in order for a DSCR lender to lend money to you. Secondly, a lot of DSCRs also go to a 30-year term, so you're going to have to qualify with the different terms that they allow you now. um, and they don't allow you up to 30 years, then whatever it is, the amount of years you're going to have to qualify from that payment perspective. Like I said, income divided by your monthly payment has to exceed 1%. um in addition to that, a lot of DSCRs require 20% down, right? So you're looking at, there might be some that say that they do 15, but all the ones that I've ever worked with that says they do 15, they're going to require you later to do more than 15%, right? So be ready for 20, 25% down. The last deal that I did, right, at first I thought that they would allow me to do 20%, but the rents came in just a little shy of that. And so they required that I actually put more money down, which ended up being a 25% transaction, right? 25% down payment transaction. Um, and so that's what we're going to be looking at doing. Now, DSCRs, right? Some of them can close super fast, right? Like some of them can close in 10 days. Um, some of them requires 45 days, right? So it just depends. Like I have a specific DSCR lender and we like to use them for short-term rentals, and no one else would do what they do when it comes to short-term rentals, meaning they underwrite the short-term rentals in-house. They don't go out there and wait for the appraisers to determine where the rents are going to come in from a short-term rental perspective, because most appraisers are out there doing residential homes. And because they're doing residential homes, they're going to give you long-term rental numbers, right? So unless you're in a short-term rental heavy area where the appraiser actually knows how to calculate that, oftentimes you get long-term rental numbers. So what that means is that the rent's going to come back lower and you're not going to qualify. Well, this lender specifically only uses their personal calculations, right, from their underwriters. They don't actually require appraiser to go out there and determine what the rent's going to be like. And so that lender takes 45 days to close their deals. But what's really nice about it is that they're not going to be using the appraiser numbers. They're going to be using in-house Airbnb numbers, right? So for short-term rentals, sometimes 45 days is going to be better than 30 days. So, but yeah, my understanding, like I think the last transaction I did was about 25 days. We closed and everything was good. So that's definitely really fast for a DSCR lender. But another really cool thing about DSCR loans is they're not going to require your tax returns, right? They're not going to look at your income. They're not going to say, "Hey, give me your pay stubs, your W-2s, your tax returns." They're just going to look at the property, right? And so that makes it a little bit smoother. In addition to that, sometimes, right, if you have a partner and they're transferring funds over for the transaction, as long as you're in business together, they allow you to do the business together, right? Say, for example, like Laura and I, if we decided that we wanted to go in on a loan together and I come up with a down payment and he manages it, right? As long as we're both on the loan, they're going to be okay with that. Or as long as we're both in the LLC, they're going to be okay with that. So that's another cool thing about DSCR loans is that they allow you to be able to do business in your LLC. So the last transaction that I did with a DSCR, we had it done under JV Realty, right, which is an LLC, and then JV Realty will also manage the property. Of course, it's owned by me, so it's managed by me, but that makes it so that my personal liabilities are not involved in my business liabilities. So bunch of different good things about DSCRs. I think a couple of things that you have to be aware of in DSCR is there are prepayment penalties most of the time, right? And so it could be like in the state of Minnesota, a lot of the DSCR lenders that I work with that actually are approved in Minnesota, they don't have DSCR or they don't have prepayment penalties because here in Minnesota, the government pretty much says that, if you got prepayment penalties, you're not going to work here, right? So a lot of them have taken it away. However, my understanding is that they do allow for a 3-year prepayment penalty here in Minnesota, even though you may not see it with many lenders. However, across most of the states, right, all the states that allow prepayment penalties, you're going to see somewhere between, on average, most of the time, you're going to see a 5-year prepayment penalty. In addition to that, if you're a first-time home buyers, they most likely will not work with you. So you have to own your own home most of the time. Once in a while, you'll find a DSCR lender that allows you to do a first-time home buyer, but for the most part, I think I've only ever come across that once. Every other lender that I've worked with requires that you actually currently own a home or have owned a home in the past or recently owned a home in the last 3 years. And then finally, they have different reserve requirements, right? So even conventional requires a 6-month reserve for each of the investment properties that you own. However, for DSCRs, you might need 12 months, right? So if you're going to come in and let's say, for example, your credit is not that strong, you're on the lower end of the 680 score, you are closer to the DSCR 1% or something like that, they might require 24 months of your reserves for some kind of like going over their guidelines or whatever the case is, right? So sometimes having more reserves is better for DSCR loans, but definitely minimum that I've seen is six months, right? So you have to have at least 6 months of reserves. And then like I said, you don't need employment history, you don't need pay stubs, you're pretty much good to go. So that's what's really cool about DSCRs.
Okay.
Now that was a lot, right? I went over a
Yeah.
ton.
That was a lot. So hopefully people go back and watch it again.
Yeah.
But yeah, I think you cover everything except for rates, right? So rates, what does that look like for DSCRs compared to investment conventional loan?
Yeah, so on DSCR loans, they're really different, right? So usually rates are higher because there is definitely more risk in those type of loans. So they usually charge a higher rate. Um, but something you have to know, right? Something you have to know is that they also charge more points, right? So if you're going to do a DSCR loan, expect to pay 2 points on average versus a conventional loan where you're paying 1 point, right? Whether that's one origination and 1 point, or just one origination on the conventional side, where on the DSCR side, it's they may not consider an origination. They might just say it's 2 discount points. But at the end of the day, right, you're going to be paying more even though the rate is higher. So
Mm,
expect that.
right. Okay. So yeah, rates slightly higher, cost to get the loan slightly higher, but
Yep.
yeah. Okay. And then so let's help people compare side by side here. Um I'm gonna give you the topic. You kind of tell me which one is better or worse, right? Or right.
Okay. Yeah, that sounds good.
So first of all, let's start off with the pain in the ass part of processing to get qualified, things like that, right? Qualifications, documentation, paperwork, right? Employment history, taxes. Which one is the least amount of work? Which one is better in that standpoint?
DSCR in that aspect,
Okay.
because you don't have to provide many of those documents.
Right. Because again, they're only looking at the ability of the property to produce income to cover
Mhm.
the mortgage debt service. Right.
No,
All
that's
right.
correct.
Credit score.
So credit score conventional will be more favorable because they actually allow you to go to, I think it was like 620, but I recommend you have like a 640 or higher. When you're getting low into the credit score, it's a little tougher when it comes to qualifying with the rate at that amount. If you can get it above 700, great. But if you can't, you could probably still do 640 and be just fine.
Mhm. Okay, so slight advantage to conventional on that
Mhm,
one.
mhm.
Rates. Which one's lower?
Conventional is definitely lower, like majority of the times.
Right. Without having to pay any additional things.
Correct. Points or
Um,
anything. Yeah.
so just something to be aware of. If you want to up your prepayment penalty from say 3 year to 5 year or 1 year to 5 years or whatever, the more prepayment penalty you add, it's actually going to take your rate down a little bit more. And then
Mhm,
also, if you increase your down payment percentage from 20 to 25%, I've seen that have a dramatic effect on your interest rate as well for DSCR.
yep,
Um,
yep,
so those things help, and then of course there are discount points available too on both sides. So you
mhm,
could pay more discount points to buy your rate down, essentially, right?
yep,
But just comparing base rate to base rate, conventional's gonna be better.
mhm.
All right, how about down payment? Which
So
one's
down
less?
payment, if you're doing a single family property,
Mhm.
conventional is gonna be better. If you're doing multi-unit, DSCR is gonna be better because when you're like, if you don't need 25% down, right, and you can only do 20, that's usually better. Now, it's circumstantial, right? So, but for the most part, if you're doing a single family, let's say you're doing an Airbnb, you're doing a midterm rental, you're doing a just a long-term rental, single family, conventional is going to be better.
All right, cool. How about speed to close?
Speed to close, I think they're pretty equal. When it comes to when my team does it, right? But I think if you're going to a bank, right? If you're going to a local bank, you're gonna need 30 days minimum on a conventional. And so DSCR might have the advantage on that, because sometimes you can close them in less than 10 days, right? So um they're Sometimes they allow, like, depending on how fast that specific lender is, if they do a lot of hard money loans, which, I haven't really talked about, but if they do a lot of hard money loans, they might be fast, like super fast. So 10 days is actually pretty quick. That's like almost faster than same as cash, because um the title company needs about 2 weeks, so about 14 days to close usually, across the nation. Um, so that being said, you could probably close faster with the DSCR loan if you get the right DSCR lender.
Okay. All right. So that should help people to compare, right? Which ones they need to
Yep.
use. Let's talk about common investor mistakes.
Yeah.
So what are some common mistakes that investors might have overlooked, whether it's conventional loan or DSCR loan?
So a huge one is prepayment penalties, right? I had an investor, she wanted to get a property, right? She's never been in this specific market. She wanted to buy an Airbnb. She purchased it in the market, and she wasn't making the revenue that she was making on a property in a different location, right? So now she wanted to turn around and sell it. Well, she's only owned it for 2 years, and there's a 5-year prepayment penalty. She ended up paying additional like $20,000-$30,000 in order to sell the property, even though she made money on it, right? Which she got lucky, so she made money on it. But she lost like $30,000 in transaction, right? So
Mm.
do not forget about prepayment penalties. Secondly, when people are jumping in to purchase a home, right? They just assume that rents are a certain number. Let's say, for example, they did some of their research and they said that the rent was going to come in at 1,500, and the appraiser appraises it and looks at the rental numbers and they came in at 1,300. Well, now you're looking at, reducing the loan amount, which means you got to come in with more down payment, or something needs to take place, right? So don't overestimate your rents. Um, and then another thing is, don't underestimate your expenses. So, for example, if you go in assuming taxes is only $2,500 a year, but it ended up being $10,000 a year, that's dramatically different. And so you may not qualify when something like that happens. And then um, scaling too fast, right, is another
Mhm.
one that people make mistakes. Is they jump in thinking, oh, okay, this one makes this much, so if I jump into the same neighborhood, I can make twice as much if I just purchase another one that's the same. Well, not every property in every neighborhood makes the exact same amount. So of course, make sure that you have the income correct, make sure you have the expenses correct, because some properties actually are more expensive than others. Let's say, for example, the square footage might be higher, right? So taxes are higher. So make sure you understand estimating your expenses and scaling too fast, right?
Yeah.
And then, I think my thoughts are is that some mistakes for some investors are emotional decisions, right? I often talk about my wife's first investment property with me. Um, she wanted something that she could live in, right? And it had to be perfect, right? And that's all fine and dandy, right? But the thing is that if you're not in the right location, you don't need all of that, right? You just need kind of like the bare minimum. You want the property to rent, so you want everything to be safe and sound and everything to be nice looking, but you don't need it to be granite countertops, right? You don't need it to be soft closed drawers or anything like that, right? And so my thoughts are is that don't jump in an investment as if it's the home that you're going to buy for the rest of your life or for your kids or your family. When you're buying into an investment property, you're buying into what makes you money, right? It is an investment. So you want to make sure that it is an investment and it actually makes you money. So don't jump in using emotional decisions. Now, secondly, right, don't get so emotional that you end up in analysis paralysis, right? So where you can't even make a move. Understand where your numbers lie, and if the numbers work, then you just move. You don't wait until you feel like it's right. you jump in. Now, I'm not saying don't go with your gut feeling, because the likelihood is that if you do go with your gut feeling, you're going to be fine, but make sure the numbers work. And then secondly, sometimes people, um, they like, so for example, if the financing requires you to have 6 months of reserves, there's a reason for that, right? So if you jump in and you use all the reserves on furnishing the property or fixing the property up to rent out, and all of a sudden, if you're running an Airbnb and you're not getting any bookings, or you're running a long-term rental and the tenant doesn't pay, you're going to be in trouble. So make sure you keep your reserves where they're supposed to be, so that if you run into any issues, toilet breaks or something like that, you have sufficient funds to go ahead and fix those things. So I think those are usually the common mistakes. Again, that was a lot, but hopefully it's good takeaway so that you can utilize it in your investment.
No, that's some definitely some good advice. All right, so I guess to kind of summarize, what's the right strategy, or who is each of these type of loans good for? Would you say?
So I think for conventional, if you're a high income producer, right, and you have a low DTI, because conventional, they do qualify off of your personal income, right, as well as they may use a portion of the rent, but they're not going to use all of it, right? Where DSCR does use all of the rent. That being said, if you have some extra cash and you have the income to purchase an investment property, conventional will probably be really good for you. And the reason is because um they have lower interest rates, and they have, the 30-year term, and they don't have prepayment penalties. So if you can qualify for a conventional, oftentimes I tell my clients that that's going to be the best case situation. If you're
Mhm.
going to buy a property and you want to scale fast, right, and you're self-employed and you're focused on just cash flow, DSCR works really, really good for you, right? So, for example, like, I'm self-employed, right? I own my mortgage brokerage, and then I'm a realtor on the side, right? I don't get paid by any W-2 employees. And so when I go um, to lenders, if I'm writing off all of my expenses and everything, I should be paying less in taxes, and therefore my income based on my income taxes is going to be lower. And so if I'm doing that properly, then when I go to the lenders, they're going to say, well, you don't make the money, right? So it's harder to qualify from a conventional perspective. So therefore, I would need a DSCR loan. And in addition to that, DSCR loans, as long as you have the 20% down, right, they allow you to scale faster. So if you have a partner for every single property that's going to come up with a 20% down, and you're going to manage the properties, you're going to be able to scale up really, really, really fast. I don't always recommend doing more than, like, I would say 3 properties a year, unless you're experienced, right? If you're super experienced, fine. But if you're not experienced and you're kind of brand new, I recommend you do one for 1 year first, and then jump on another one later on. But if you've had a few and you're able to scale a little bit faster, say for example, you just want to double your portfolio, you already got 10 properties, you want to double your portfolio, all of the 10 is already on conventional, well, you're going to have to go DSCR because you're maxed out on your conventionals, right? So I think that would be really, really good. Perfect strategy for someone that's investor heavy and has already used their conventional loans, or is self-employed and wants to scale fast. um, and my thoughts are, the universal rule is bad math kills deals, right? Not quite loan types. So that means that if you're not underwriting your transactions correctly as an investor, right, and you haven't talked to a loan officer to get you pre-approved, whether that's conventional or DSCR, then the likelihood is that you probably will run into issues where you're just not, like, you don't know if the numbers are going to actually truly work or not. And so my thoughts are is that run your math, make sure it's correct, and then run it against a loan officer and see if they agree. And if they do, you'll probably be just fine.
Yeah, yeah, great points. So that brings us to our recap here. So, essentially, at the end of the day, think of the different kinds of strategies of funding, right? Funding, the different strategies that we talked about for funding and the loan types more as tools in your tool belt, right? So that you're aware of them and when to use which one for what scenario that you're in, right?
Mhm.
So, for example, if you have a ton of cash, if you're fortunate enough to, be like Scrooge McDuck, right? You got that bank full of cash. Cash is going to be like a sledgehammer, right? It's going to get things done for you quick, all right? But it's a lot to spend all at once, and once you drop it all, it's gone, right?
Mhm.
And then you got things like a conventional loan, very precise, right? Low energy, low cost, right? Lowest cost, but like a hand tool, it's going to be slow, can be a pain, right? It's going to be a long process, but it gets the job done, right? But then we have DSCR options in your tool belt here. So think of it as kind of like a power drill, right? So faster, a little bit less painless, but there's going to be more cost involved, right? Because
Mhm.
it uses more energy, right? So
Yeah,
as
drill
long
costs way more than a screwdriver.
those batteries are expensive, man. Yeah. So that's kind of how the analogy that I would say to think of, right? Um, so also, if you're out there and you're wondering, okay, well, all this information is great, but I'm ready to invest. Where do I start? Right? Where do I go and learn about these loan options, about the intricate details? Because again, every lender is different, and even Johnny and myself were mortgage brokers. We have a number of different lenders that we can shop with, right? And even
Mhm.
those lenders have different programs and different
Mhm.
terms and things like that, right? So the best way for you to learn, the best to get started, right, is reach out to a professional that you know, you like, and trust, whether that be a realtor that can refer you to a loan officer who is investment savvy, or if you already know of a loan officer who knows their stuff on investment loan, right? Um, Talk to those people, start learning as much as you can, ask questions, and get ready, right? Get pre-approved, get ready. And then, just to kind of close out, if you do have any real life scenarios, deal scenarios you want to run by, questions that you can't find anybody else to answer, and you're watching us because you know us, feel free to reach out to us, ask us those questions. We'll be happy to help you out. Um, Definitely, follow us on our socials, right? So our Facebook page, Ninja Wealth Exchange. Um, Subscribe to that community, give us a like, find us on Facebook, like us there. There is a community option on YouTube as well, actually. You can ask questions on there too. So that's pretty much it for this episode on how to, fund your first deal, whether it's your first deal or your next deal, how to secure that bag the smart way, right? So until next time, keep grinding, keep working, and we'll see you in the next episode. Anything you want to say?
Later, guys.